North Korean leader Kim Jong-il dies, worries spread about a stable succession plan. The U.S. dollar index climbs as worries mount that France might lose its AAA credit rating. And European finance ministers meet today to debate funneling 200 billion euros through the IMF. I'm Alix Steel, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Alix Steel with TheStreet, and together we bring you the morning call. Scott, let's get right to it. Kim Jong-il dies. What does that mean for the markets and for you as a trader?
Just another thing we have to watch out for. There was always uncertainty in North Korea, but now that he's dead and the son's taken over, you never know how he's going to want to flex his muscles, how he's going to want to prove himself, how he's going to do that. But I think you can't trade on anticipation of that. You just have to know in the back of your mind that one day, he might start, what was it?
Saber rattling.
Saber rattling. And at that point, hopefully you're not long too much, because that might not be a great open that day.
Right. But we do have a lot of headlines that are mounting, like you said. European finance ministers meeting today to discuss sort of putting through that 200 billion euros through the IMF to other European countries. We also have Congress not cementing a deal to extend the payroll tax into 2012. More uncertainty, more headlines here. What do you do when futures are up?
On my way to work, I was trying to figure out what could excite the market, what could cause a nice move in the indices, not just this lethargic type of drip-drabby type of trade. And I don't even really know. As far as extending the payroll tax and the unemployment benefits or insurance, they said we'll go out 2 months. I think everyone scratched their head and said, what is that going to do?
Well, Speaker Boehner said no 2-month deal. That's the problem now. So
it's either going to be it's either going to be a year or nothing.
It seems like it for now.
For now.
Yeah.
until they change that again.
Right.
But then you also have all this stuff out of Europe. Do we get the downgrade in France finally by S&P, and can we blow that off? Would that be exciting? So I think traders have to have a list of things that could happen over the course of the next week or two, and then what levels to watch and how the market can deal with it, because it's going to be a very thin tape. A lot of the leading traders, a lot of the guys that are running the desk, they're already on vacation, so you have a lot of second and third string people behind the realm, so that can create volatility.
So what does that mean? Do you go long your 5, 6 go-to stocks and you're short in the spiders or something? I mean, how do you prepare?
I think that trade's off the table. Last Tuesday when we failed, after the Fed minutes, and you saw a lot of the momentum leave the momentum names, you saw another area in the S&P break. That's when I said I'm not holding these 5, 6 names anymore, because I don't think Santa's coming. The trade changes, I think we could buy versus support. More of a sniper approach. I'm no longer in the camp that we're going to get this huge move over 1260. We stopped that. Remember, we talked on Wednesday. I'm like, that trade's off the table. Now it's a time to expect less, be safe. I think that stocks underneath the surface are acting a lot worse than the actual indices themselves. So there's a lot of danger out there, so don't have too much risk on. Just take trades as they come.
All right, so then as a trader, then you're looking for quick, cute trades, cash flow. But as an investor, do you need to just sort of stand on the sidelines or take opportunities when we do have a down day to buy long?
Well,
versus certain levels?
We talk about the macro approach, and if you're still a macro investor and you didn't, just say you didn't sell when we broke that 1100 back on October 4th, you're still in your position and you're still holding them, but only tier 1. This is not an environment for anything more than a tier 1 or a tier 2. If you are in those positions and you're watching every day, then there'll be spots to add for cash flow. But really, owning stocks, according to IBD right now, which has us in a market correction, or owning stocks if you're not watching is very dangerous right now. I'm more in the camp that you have to take quick trades, and that's what my traders are going to be doing, especially guys with small funds and momentum. They're not taking risk right now. They're just trying to create more cash flow to end their year.
All right, so let's go to the SPX and see what are those key levels you're going to be watching now for this week.
Okay, well, if you take a look here at the chart, you'll see that we've had 2 big ranges here. You had this nice rally from the outside day. We put that level of 1250 to 1300, went all the way to 1292. That feels like it was a decade ago. It was only a few months back. And then we retraced. And what did? We held this 0.618% retracement of this entire move. So I want to try that again. It worked the last time. Obviously, it didn't hold the higher retracements, but still hung in there. So now if you look where we are, even though we couldn't get through this downtrend, we couldn't get through 1262, we're still above this 0.618%, this 1202, which is still this uptrend. Now look what happened after the last move. No one thought that it can go higher again. It did. So this will be that macro level to watch, and who knows, maybe it doesn't get tested until early next year. But until then, you have to know that's in place, and you have to know that anything can happen really right now.
So that is the line in the sand. So let's get to some of the sectors and stocks then that have not been performing well, have broken through those technical levels, and that's going to be gold in my book, down 7% last week, below its 200-day, which is now about 1610. Can't get above that $1,600 level, Scott. It just seems like regardless of what kind of level that is, traders are just taking that opportunity to sell any kind of rallies that they're seeing. I do want to point out that last week it seemed like a lot of the damage in gold was done in the futures market. The GLD over the whole week only sold about 15 tons, which really isn't that much considering the fact that gold was off about 7%.
Yes, and gold has a lot to prove. It just broke through its 200-day, I think, like 3 sessions ago. So you have to give it some time to try and get back above it. And typically when a sector or a stock breaks its 200-day, it's very, very negative. It seems for gold, because it's so violent, it likes to whip people out because you have your stop loss there. But then if it reclaims that 200-day within the next 5 to 7 sessions, I think the stat is 2/3 of the time, it's up a lot the next 3 to 6 to 9 months. So we'll know the exact temperature of gold. If it can get back above 16, 16.10 with some type of force, okay, we're going to see some lower prices, and those lower prices could be 14 to 14.45 going into the first quarter of 2012.
And I mentioned last week that Bespoke had a note out that said in the next year after gold is broken its 200-day moving average 6 times since like 1976 or something, 1974, that it actually rallied 20% in the next year. So
exactly.
Yeah.
So let me just show you the chart real quickly so you can see that level. So you look at the GLD. There was a lot of things you could have seen here, so I don't feel bad if you got stuck in your gold. This was that, reversal, that outside reversal day, also double top. This was, sell a tier if you were in more than tier 1 long. Then you had this pattern of indecision. If you look really close here, this was that outside day where it failed to go through closing the low. Another sell signal before this big decline. Then you came back, retested, couldn't get through there. There's that downtrend. And then this macro wedge broke quickly to the downside. So right now we're holding this level, which you could see more in a macro approach. You could see this was that prior breakout in July. So we're holding now. If the GLDs can't get back above 157, 158 with any kind of force and volume, you could see this lower level of 140 to 145, as I said, going into 2012.
And I want to touch on silver very quickly because that was down 8% last week, but it didn't break below its 200-day moving average. What does that mean technically?
At this point, I think there hasn't been as much interest in silver. Every time gold tried to run, they tried to take silver with it. You had that one really funky trade, the parabolic move up to almost 50. Yep. So it was a good long, good short. But for now, the SLV is holding above the October low, which the GLD is not. This was your last little, wedge type pattern right here that resolved to the downside. So if you are trading long, you could trade it versus low here of around 27. That's that October low. But if it breaks below this, and doesn't even fill this gap, you could see a lot lower levels in silver as well.
And Scott, let me tell you what I'm hearing from analysts in terms of the gold miners for next year. I'm hearing a lot that the M&A is going to be really hot next year because we're seeing this decline in the gold price. Small juniors have gotten pretty beat up because they have that juicy leverage, and so now they're even cheaper than they were. And M&A already started to pick up. We saw Eldorado Gold buy European Goldfields over the weekend for almost a 50% premium. So if that kind of picks up, what do you do with the gold stocks? I mean, how do you trade? How do you get the safety, but how do you get that little sexy at the same time?
That's tough because if you're going for quality and you're like, just say you're in Newmont, you're not trading Newmont for a takeover because it's such a behemoth.
No one's going to take it over,
Exactly, they're going to be the ones.
Right.
So the question is, you have to really fundamentally like one of those junior miners, and I don't know enough about them. You know a lot more than I do there, because every time you try and be long the miners, they always have a problem, whether it's a setback in the mine, whether they do a secondary.
It just takes a long time for the production to come online. So, okay, if you're not playing the juniors, I just want to check in with the Rand Golds of the world. They're not going to be buying anything. They're all into organic growth. GOLD is the ticker. Want to see what support levels it held. Okay,
if you look here at GOLD, you will see that it's trying to hold this support going across right around the 200-day. So, it does have a bit of a bounce off it, but there's a lot of resistance to this 105, 107. This is the last time it tried to break out. This is when momentum left. This was your stop at 115, and now it's just been a trade like this. And if it can't get back above this 105, you better be careful. It starts to get below this 96 and breaks below its 200-day.
All right, let's go to Royal Gold, not a miner, right? A royalty company. Talked about it last week. Wanted to see how it held up in light of that big sell-off we saw.
Okay, if you look at this chart right here, you will see that this was a candidate to make a new high, get above resistance for momentum. But you know what? It broke. So if you're watching it real closely, the whole idea when you trade momentum, if it leaves, you have to leave quickly. So when it couldn't break above this resistance, above this 81 or 82, plus you have this other resistance area, you had to get stopped out once it broke below this 77. If you did so, you have the opportunity to trade it again. Now it's developing a little pivot here. I would watch this very closely. If it starts to break above 70, maybe it fills a gap to about 73. But then if it turns tail there and then breaks this area, you're going to see it move down to the 200-day. So you have to really trade this one.
All right, so again, key levels for some gold stocks that might have some more downside. We're going to talk about some more quality stocks like an IBM and McDonald's right after this, so stay with us.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Our quality stocks still safe bets. Let's look at IBM, a dividend of over 1.5%. You know, Buffett buys. Third quarter was pretty rocky, but the news has been well absorbed at this point. Is a quality name like an IBM breaking down here?
I wouldn't say it's breaking down yet, but it's lost some momentum. And this was a stock that was a candidate for new highs, a candidate for Santa to come. So this gives us clues that, you know what, Scrooge might be coming, not Santa, because if you look at the levels here in the chart, you will see this upper area broke. So if you were playing this for momentum and you thought that this area would hold in there and then you can get a move, which made sense at the time, above 195, you had to get out of the way once it broke this level. This was the prior breakout. This was your support holding. Once it broke 188, if you were in like a tier 2, you had to get back to a tier 1. And now it's holding this uptrend that's intact from September. So this is your next area to watch. If it can't get back above this 185 and starts trading sideways, this uptrend breaks, you could see it move down to here. But we've seen this before. You saw this happen here. You know, it was short-lived. You know, held the trend line and then made new highs. So maybe it does it again. You know, you just have to know your time frame with IBM. But traders definitely left this here. Investors, I still think you could stick around. And
then for McDonald's, though, in particular, I feel like it had such a great quarter. November same-store sales were up in Asia. They were up in Europe. And they were up in the U.S. overall, up over 7%. I mean, these are solid numbers. McDonald's reporting has a nice, juicy dividend, has that emerging market growth. It seems now resilient in the European bad headlines. Doesn't this make a good candidate even if the stock is selling off?
It's a great candidate, but this has a chart very similar to IBM before IBM lost some momentum. So if you're not committed to McDonald's, you have to watch this close. So take a look at the chart. You will see that you have a nice upper level flag. So if anyone's trading this for momentum, thinking Santa Claus is going to continue here, they need to see it get above this area. But you know what? It's very choppy in here right now. So I think traders are actually watching that if the market gets hit, they might be able to short, you know, McDonald's below 97 for a move to retest, you know, this uptrend. And if you're playing it in a tier 2, you know, as a macro investor, it breaks this level, just get back to a tier 1 so you could ride it out. It could also even get down to this, you know, the 50-day moving average. So if you're not willing to hold from 97 to here, you better have a stop right at this upper level.
But couldn't you also make the argument that if we do see any sort of European funds or institutional investors need to get into some stocks in the next 2 weeks, that McDonald's would be a prime candidate? Or do you think that's not going to happen?
It is a candidate, but again, you know, it's a candidate until you leave, you know, see the momentum leave.
Hasn't been there
so
yet.
IBM was a candidate, and now it's a candidate to buy at the uptrend, not through new highs. So McDonald's, it's still in the game, but if that game changes, you better change with that game.
Two more, a few quick stocks we want to hit on. Apple, is it still in the game? You know, 88% of all its ratings are buys, which is really impressive considering that 57 analysts actually cover it, but has not been performing well.
Apple's been a great micro trader lately. The macro pattern's a bit more bearish than I would like because I'd hate to see Apple start to break down, but you got to call a spade a spade. You've had some nice trades here, but you have to watch this pattern develop. You know, Apple, I know it's trading at a forward PE of 12, which is dirt cheap, but, you know, who knows? It could get, I guess, cheaper. So take a look at the chart here. You will see that, you know, if you guys remember this little pattern right here, this was when we had a nice clean trade when it broke the 50-day for the first time in a while. You had a trade from 394 all the way down to the 200-day. You know, then little micro trade to buy it when it broke this descending channel here at 376 to the upside. Then you had this little flag pattern that then resolved to the downside. So on a micro level, if this thing starts to break below 377 for cash flow, I might even try and short this. Okay, but then right here, this 366 is the big macro pattern. You have the left shoulder, the head, the right shoulder. If Apple starts to break below 367, 368, it could be a long way down, and you know that wouldn't be really good for this market at all. So look where it is on the weekly chart. It breaks below this trend line. You know, you have a move down here to about 300 before some major support, and then the 200-day here is 253. So let's hope this 366 holds.
And then last stock I want to hit on is MasterCard, sort of the non-bank bank that we talk about a lot. How is that shaping up in light of the financials also getting hammered?
Also a big candidate for moving to the end of the year, but it's starting to get choppy because people are losing interest. People are losing some support, or they're thinking that it might not happen. So if it's not going to happen, it won't happen here as well. So if you go to the daily chart, you will see that, you know, you have this little bit of a perch here. So if it starts to break below this 360, you better measure your commitment to this thing because it could easily come into 350 or 345. This is a short-term uptrend that it's trying to hold. You know, momentum left the stock a little bit right here. So if it breaks below this 360 and the market rolls over, you could see a move down here. So better know your commitment level.
All right, let's get to some quick ways you might be able to make some cash today. Scott, Google. Does it have the juice? Can it actually sustain a breakout, or are we looking for more of a consolidation?
I think it's trying to hold 620. It's in the game. It's my #1 stock for 2012, but that's on a macro level. Micro level, just trade it when the market's strong. It's a good go-to stock. Otherwise, avoid it.
And JP Morgan, what about this stock? It has the highest percentage of all of its ratings of all the banks. This one's the best. It has about 92% of all its ratings are buys. That's huge for JP Morgan.
It's huge, but it doesn't do much for the stock.
Fair
The stock's
enough,
been in the doghouse just like the rest of the banks. I've been using Goldman Sachs as more of a gauge, but if you look here at JP Morgan, you will see, it had a big move off the lows. It's trying to hold above 30. If you had to be long, trade it versus this 30 level. If it breaks below this, you're going to see a lot more weakness in the banks.
And switching gears, what about Amgen? Is that a good trade for traders right now?
I've been seeing some support in these stocks. I've been seeing more people talk about it. If you take a quick look at Amgen, you'll see, it's trying to break out. It was good to be long in this space. I would say watch this gap here as long as it stays above, this 59 or so. You're going to see pent-up energy. This could be a great stock for 2012.
And what about defense stocks? If you look at, say, the Northrop Grumman, or if you look at the Lockheed Martin, with all the North Korea news, do you think that traders might be playing this cute today?
I think they might gap up based on what happened in North Korea, but traded versus the gap up. There's my Monday tongue. So watch them today. If these stocks hold up today and then close in their highs, you'll know it's for real. But if it's just a one-day wonder that people are emotional and they sell off, then just take your own thesis there. It's not in vogue for right now.
And last stock, want to hit on Sina. Been a really good trade for you this year, but what's it showing you right now at the end of the year?
It's been very, very weak. But on Friday, it had its first outside day in a while, so this could take some pressure off. We talk about an outside day. Here you go, which is a massive green bar after a huge decline. So I would say, watch it from the long side. If you can get above Friday's high of 55.34, you could see it move back to 60, 63 before some resistance come in, but just for the active trader.
All right, and then rounding it out here, I just want to ask you, Scott, how do you deal with low volume headed into these 2 weeks when the typical history said we're going to see the Santa Claus rally in the midst of this low volume? How are you dealing with that?
It just
yourself.
You don't fight it. You don't fight whatever move's taking place that day, because people say, oh, it's not a real move if it's on low volume. But if you're short, a stock goes up $5 in your face on low volume, it hurts. If you loan that stock and it goes up $5 on low volume, you can make some money also. So it just means that there's not as much liquidity. You don't have as much give. It means that you have to be in less size so you can maneuver it better, because if you're in a lot of size and there's no volume, you're not covering and you're not selling. So just do a little bit less and expect a little bit less.
We'll end it there. That's a perfect close. Do a little bit less and expect a little bit less. All right, I'm Alix Steel from The Street. Happy trading, everybody.